In a shocking and desperate move, the Trump administration has just done something unprecedented. The U.S. Treasury's Undersecretary, Scott Bessent, is now officially demanding that a major global lender, the Asian Development Bank, immediately cut off all loans to China. That's right. Washington is pulling emergency levers in an effort to choke off China's financial lifelines. This isn't just political theater. It's a direct strike on China's access to development funds. Funds that China has relied on for years to grow its global influence. Now, the U.S. wants that pipeline shut down. Why? Because behind closed doors, the White House is in financial panic mode. The dollar is under pressure, inflation is climbing, and China is taking more control over international trade. The U.S. feels cornered, and this is Trump's counterattack. The administration is now going all in with aggressive tactics. While confidence in U.S. Treasury bonds is fading fast and interest rates are rising to unsustainable levels, China is gaining ground with low borrowing rates. That gives Beijing access to cheaper and more plentiful funds than the U.S. can manage. So what's Washington's new strategy? Force major banks to stop financing China, even though China currently holds a better credit rating than the U.S. Is this just a warning shot or the start of something much bigger? Before we continue, make sure you're subscribed to the channel. Thanks. Now Trump has returned to a well-known strategy, slapping tariffs on China. He sharply increased import taxes on over $600 billion worth of Chinese goods. Some products were hit with outrageous tariffs as high as 145%. The message was unmistakable. Trump wanted to punish China and push U.S. companies to bring manufacturing back home. But things didn't go according to plan. Instead of damaging China, the move rattled global markets. Yields on U.S. government bonds spiked, foreign investors began to pull out, and trust in America's economic stability started to shake. For decades, the world saw U.S. Treasury bonds as one of the safest places to store wealth. Now, even that confidence is starting to erode. Trump believed tariffs would strengthen America, bringing back factories, jobs, and leverage. But here's the cold truth. You can't win a global trade war if your own economy collapses first. And if tariffs aren't doing the job, what weapon does the U.S. have left? When tariffs didn't deliver the expected results, Trump shifted to Plan B, massive corporate tax cuts. Back in 2017, his administration already slashed the corporate tax rate from 35% to 21%. Now, he's aiming to drop it further to just 15%. On paper, this sounds like a win for businesses. Lower taxes mean more cash for hiring and building. Companies like Tesla and Foxconn started hinting at new U.S. investments. But here's the problem. It's extremely expensive. These cuts could cost the government nearly $9 trillion over the next decade. That's around $900 billion per year in lost revenue. So where will the money come from? Of course, borrowing. To fill this massive gap, the government needs to sell even more Treasury bonds. But there's a catch. Investors aren't exactly eager to buy U.S. debt right now. And if lenders demand higher interest rates, borrowing becomes even more expensive. It's a dangerous cycle. More debt leads to higher costs, which leads to even more debt. Trump is betting that the tax cuts will spark enough economic growth to make the debt manageable. But what if he's wrong? The biggest obstacle standing in Trump's way? China. So how do you take China out of the equation? That's the real question. But before we dive into why China poses such a challenge, let's take a closer look at why the U.S. bond market is currently a mess. In the past, America could rack up huge debts because global investors trusted U.S. bonds. That trust is now fading. In March, the yield on 10-year U.S. Treasury bonds briefly hit 4.5%, and the 30-year yield jumped to 5.1%. This triggered alarm bells across financial markets, which were already nervous about a looming recession. Japan, one of the largest holders of U.S. debt, with over $1 trillion, began quietly selling off treasuries. Other foreign investors followed. At one recent auction, demand for 5-year Treasury notes from foreign buyers dropped from the usual 70% to just 64%. That may not sound drastic, but in the bond market, it's a major warning sign. As yields climb, it costs the U.S. more to borrow. That affects everything. Mortgage rates go up, credit becomes harder to get, and companies hesitate to expand or hire new workers. Why are investors pulling back? The simple reason is fear. Trump's unpredictable tariff moves, combined with huge tax cuts and ballooning deficits, are making the United States look like a risky investment. And when investor confidence drops, the cost of borrowing goes up across the board. So what happens if the United States can't easily borrow money anymore? What if the bond market begins to push back? Here's the surprising part. While America's bond market struggles, China's is gaining strength. As global investors ditch United States debt, many are now looking toward Chinese bonds instead. Yields on China's 10-year government bonds dropped below 1.7%, even lower than Japan's. That's extremely low, meaning China can now borrow money at cheaper rates than the US. But why is this happening? Because even during a trade war, many investors see China as more stable. Beijing acted quickly to calm markets. It issued long-term bonds and invested in infrastructure and energy. Investors from Europe, the Middle East, and even the US jumped in. Now China looks like a safer and more attractive place for investment. This is the exact opposite of what Trump hoped for. His trade war was meant to hit China hard. Instead, it made China appear more dependable in the eyes of global investors. Even more concerning, China now has access to cheaper money. Money it can use to expand factories, fund new technologies, and support allies, while the US struggles to manage its growing debt. For decades, America's economic power wasn't just about innovation or industry, it was about trust. Trust in its institutions, its markets, and its leadership. But now, that trust is breaking down. The United States is walking a dangerous line soaring debt, higher borrowing costs, and fading global influence, all coming together at a critical time. And if the world loses confidence in America's bond market, the damage won't stop at Wall Street. There would be less funding for defense, healthcare, and infrastructure. It could spark deeper inflation, slower growth, and a reduced role on the global stage. Trump's policies may appear strong, but strength without stability is just noise. The real question isn't whether America can win another trade war. It's whether it can afford to keep fighting abroad while losing the economic battle at home. With tariffs failing to hurt China and the U.S. bond market under pressure, the Trump administration has opened a new front in its economic war, targeting multilateral banks. At the heart of this strategy is the Asian Development Bank, or ADB, one of the largest lenders for infrastructure in Asia. The White House, led by economic advisor Scott Bessent, is now pushing to get China removed from the list of eligible borrowers. Why? Because the U.S. believes China is using low-interest loans to quietly grow its influence in developing nations, sometimes using money that comes from America's own allies. China can borrow from the ADB at rates that are sometimes even lower than what the United States pays through Treasury Bonds. Then, it uses that cheap money to fund projects in countries desperate for infrastructure, especially in places where the U.S. has little influence. After all, China is now the world's second-largest economy. Why should it still get special financing? But underneath this is a bigger game, one that could disrupt the global financial order if it backfires. On the surface, China borrowing from development banks might seem harmless, but there's a clever financial move happening here. By tapping into multilateral lenders like the ADB, China gains three big advantages. It reduces its own financial risk by not relying only on domestic banks. It saves valuable foreign currency, especially US dollars, by using outside funds. It borrows cheaply, then turns around and lends that money at high interest rates. In some cases, China takes the low-interest loans it gets from ADB and uses them to fund high-interest loans to financially unstable governments. That brings in profit and political influence. This is what alarms Washington. China isn't growing its power through military might. It's doing it by using financial tools designed to help poor countries, and many of those tools are funded by the West. It's a kind of financial judo. China is using the West's own resources to shift the balance of power. And here's where it gets almost ironic. If it weren't so alarming, it would almost be impressive. China acts as both a donor and a borrower at the Asian Development Bank. That means it helps fund the bank, just like the United States, Japan, and Europe. But here's the twist. Unlike those countries, China also takes out loans from the same institution. In simple terms, China is sitting on both sides of the table. With one hand, it contributes money to the Asian Development Bank, and with the other, it pulls funds out at favorable interest rates and invests that money where it sees strategic advantage and potential alliances. Meanwhile, the United States and its partners keep contributing but don't touch the money. In financial language, China is using house money to expand its influence. Washington sees this. It's been monitoring the situation for years. But solving it isn't easy. If the U.S. tries to cut China off, it could damage the ADB's reputation, maybe even cause a major breakdown. It would also ignite a serious diplomatic conflict. Right now, the economic pressure on the U.S. is building fast. The ongoing trade war with China has made imports more expensive. That hurts U.S. businesses and raises costs for everyday Americans. At the same time, interest rates have surged, reaching multi-year highs. That makes borrowing more expensive and slows down the economy. Even the U.S. bond market, once the most stable investment in the world, is beginning to show signs of strain. Three major forces are behind this shift. 1. Global investors are getting tired of Washington using the dollar as a political weapon. Years of sanctions and asset freezes have pushed countries to look for alternatives. 2. China's economy, though slowing in certain areas, still appears stable enough to deliver solid returns. 3. China's close partners, especially within BRICS, are more inclined to support Beijing than Washington. This could change the financial landscape. If China keeps pulling in international investment while reducing its reliance on U.S.-controlled systems, it may soon be setting the rules of global finance. The dollar still leads, but cracks are forming, and others are ready to step in. The United States believed it could hold China back with tariffs and tech bans. But what's now becoming clear is this. China found a backdoor route to power. By working with multilateral banks, offering appealing bonds, and carefully managing its economy, China is gaining ground, and doing it quietly. Let's break this down clearly. 1. If China continues playing this strategy with the same precision, the United States could end up outmaneuvered, not in wars or trade talks, but in the subtle workings of global finance. By the time Washington realizes what's happened, it may be too late. China could have already rewritten the playbook. So, the question isn't if America loses financial dominance, it's how soon and what follows. If you want to stay ahead of this global power shift, make sure to subscribe. Because in this new financial era, information isn't just power, it's survival. See you in the next one.